Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi dan salam sejahtera. Terima kasih kerana menghadiri sidang akhbar pada pagi ini mengenai prestasi ekonomi negara pada suku ketiga tahun 2023 dan juga perkembangan moneteri dan kewangan oleh Bank Negara Malaysia dan Jabatan Perangkaan Malaysia. Jabatan Perangkaan Malaysia merupakan agensi rasmi yang mengumpul dan menerbit statistik KDNK negara. Please allow me to continue the presentation in English for the benefit of our international audience. Global growth in the third quarter of 2023 was moderate, weighed by higher interest rates and elevated inflation. And China's growth showed early signs of improvement as consumption rose, though its property market remained weak. While global core inflation continued to moderate, headline inflation edged up, albeit temporarily, partly due to higher commodity prices. Regional exports showed tentative signs of recovery. This was in line with the nascent turnaround in the global E&E sector. However, headwinds remained due to moderating demand conditions, shift in consumption from goods to services, and ongoing trade restrictions. Let me now hand over the presentation to Datuk Sri Dr. Uze to announce Malaysia's GDP performance in the third quarter of 2023. Datuk Sri Uze.
Terima kasih Dr. Gamna. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh dan salam sejahtera. Pada suku ketiga 2023, ekonomi Malaysia berkembang 3.3% disokong oleh peningkatan permintaan dalam negeri, pasaran buruh yang terus bertambah baik serta aktiviti pelancongan dan pembinaan yang semakin rancak. Namun permintaan luar negeri yang lemah dan pengeluaran perlumbungan yang lebih rendah telah menjejaskan pertumbuhan ekonomi negara. Dari segi pertumbuhan suku tahun ke suku tahun pelaran musim, KDNK menunjukkan momentum pertumbuhan yang lebih kukuh, iaitu mencatatkan sebanyak 2.6%, iaitu peningkatan berterusan sejak suku keempat. Manakala melihat kepada KDNK bulanan, pertumbuhan KDNK pada bulan Julai ada sebanyak 4.2%, pada bulan Ogos 3.2% dan pada bulan September 2.5%. In the third quarter of 2023, the Malaysian economy grew by 3.3%, supported by expansion in domestic demand, continued improvement in labour market conditions, and rising tourism and construction activities. However, the weaker external demand and the lower mining production has weighed on growth. On seasonal adjusted quarter-on-quarter basis, GDP this quarter saw a stronger growth momentum of 2.6%, which is a continued improvement since the fourth quarter of 2022. On the expenditure side, expansion in domestic demand was driven by both private and public spending. Higher private consumption growth benefited from favorable labour market conditions, with expansion in both necessities and discretionary spending. Growth in investment reflects continued capacity expansion by businesses as well as fixed asset spending by the government and capex by public corporation. However, net export continued to contract as weaker external demand weighed on goods and goods export growth. Looking at the supply side, growth is driven mainly by the services sector and construction sector. Growth in the services sector improved across both consumer and business-related subsectors. The sector also continued to benefit from improving tourism-related spending. For the construction sector, growth was supported by the progress of ongoing large infrastructure and small-scale projects. Meanwhile, the manufacturing sector recorded a marginal contraction, mainly on account of further weakness in E&E cluster and lower production of refined petroleum product. Let's now turn to the balance of payments. Malaysia current account balance in the third quarter of 2023 recorded a continuous surplus of RM 9.1 billion, equivalent to 2.0% of the GDP, mainly supported by higher goods surplus, followed by lower deficit in services and secondary income account. Services account recorded a lower deficit of RM 10.3 billion in the third quarter of 2023, supported by the continued recovery in inbound tourism and consumption. On the income front, the primary income account posted higher deficit of RM 11.0 billion, mainly due to higher income generated by foreign companies in Malaysia. Meanwhile, secondary income account registered a lower deficit of RM 2.2 billion. During this quarter, foreign direct investment (FDI) posted a higher net inflow of RM 7.2 billion as against RM 3.1 billion in the preceding quarter. Higher FDI inflows supported by larger inflows in debt instrument and continued equity injection from foreign investors. The largest recipient of the FDI was services sector, mainly in financial and mining quarry sectors. Hong Kong, China, and the United Kingdom were the primary sources of FDI during this quarter. In the meantime, direct investment abroad outflow expanded to RM 13.4 billion, particularly in services sector. The top three destinations of DIA Malaysia were Indonesia, Angola, and Vietnam. Thank you. Let me now hand over back to our governor.
Thank you, Dr. Sri Dr. Uze. As we can observe from the GDP performance in the third quarter, the impact of weaker external demand on the economy was cushioned by the resilience of the domestic demand. Looking ahead, Malaysia's economy is expected to grow between 4% to 5% in 2024, and this is underpinned by continued expansion in domestic demand and improvement in external demand. The key factors driving growth are, first, better employment and income prospects, which will help strengthen domestic demand. Second, the realization and progress of multi-year projects. Third, improvement in the global tech cycle, which is expected to lead to higher trade activities. And fourth, continued increase in tourist arrivals, which will spur growth in tourism-related sectors. Let's move. Household spending will remain the anchor for growth, and this is driven by continued employment and improvement in income levels, sound financial buffers, and support from targeted government measures. Let me explain this further in the next couple of slides. The favorable labor market conditions is the key driver for household spending. Unemployment rate declined to 3.4% in the third quarter, and is expected to improve further by the end of 2023. The gradual decline in unemployment was driven mainly by continued expansion in employment. And going forward, strong job creation data suggests that employment will continue to expand. Furthermore, labor participation rate is also at a historical high of 70.1%. These factors would support further growth in income and consumer spending. Moving on to investment. Investment activity will be supported by progress of new and existing projects, for example, in E&E manufacturing and data centers. Investment would also be boosted by factors such as easing labor supply, stabilization of input costs, and implementation of structural policy measures through the NIMP and NETR, which includes projects such as the Kasawari carbon capture and storage and the EV charging stations. I must re-emphasize that these investments are not only important in supporting immediate growth, but also to enhance Malaysia's future growth potential and competitiveness. In this regard, it is crucial to ensure that the high investment intentions and plans are facilitated and realized. While exports declined in the third quarter of 2023, given the slowdown in global trade in goods and a high base in third quarter 2022, this is offset by the higher travel receipts during the quarter. Notwithstanding this, Malaysia's diversified export structure has also partly contributed to export resilience. This is reflected in our export performance, which started to decline much later than some regional economies with a smaller magnitude of contraction. There are also some signs of stabilization in export growth as reflected in the turnaround in the quarter-on-quarter seasonally adjusted export growth. Next slide. Exports are expected to gradually recover in the near term. The global semiconductor sales, which have been declining in the first half of 2023, is now showing signs of turnaround recently. The World Semiconductor Trade Statistics is projecting a positive growth of 11.8% in 2024 as compared to a contraction of 10.3% this year, which will help to lift our exports, especially in E&E products. In addition, tourism-related activities are expected to pick up further. As of third quarter 2023, travel receipts have reached 78% of the corresponding period in 2019. This is expected to continue to recover moving forward and return to pre-pandemic level in 2024. As of first half of 2023, tourist arrivals in Malaysia have reached about 70% of the pre-pandemic level, in line with most economies in the region. The recovery is driven mainly by regional tourists from Singapore, Indonesia, and Thailand, with Chinese tourists having the largest room for catch-up growth in 2024, providing good prospects for Malaysia to benefit. Given this, we should intensify our efforts to ensure Malaysia continues to be an attractive global tourist destination. By the way, I should mention that although the chart on the right-hand side here shows tourist arrival from China being an outlier, as I've explained earlier, this owes much to factors such as the lack of flights and issues with passport renewals in China when they reopened recently. These constraints are easing. The latest figures, which will be released soon, will show a much improved figure. The overall growth projection of 4% to 5% next year is subject to both upside and downside risks. On the global front, slower than expected recovery in external demand is a key downside risk factor. On the domestic front, weaker labour market conditions, more severe shocks from commodity production due to stronger impact from El Nino, and the prolonged plant maintenance could also potentially weigh on the growth outlook. There are also upside risks from stronger than expected tourism activity, faster recovery from tech cycle downturn, as well as a larger impact from the progress of multi-year investment projects and policy measures under the national master plans and blueprints that were announced recently by the government. This time around, we have a box article where we describe the resilience of the Malaysian economy in recovering from the pandemic. I would recommend you to give it a read. As of second quarter 2023, on a seasonally adjusted basis, Malaysia's GDP had exceeded pre-pandemic levels by more than 10%. The recovery was led mainly by the manufacturing and services sectors. Despite the external challenges, Malaysia's diversified exports and tourism rebound have contributed to the country's trade resilience. Furthermore, the improving labour market provided job and income opportunities, especially for the vulnerable segments. In essence, our economic fundamentals have enabled the country to weather the current slowdown in external demand, and the outlook is for further improvement in our growth prospects. Now let me turn to inflation. In line with the easing cost environment, headline inflation continued to trend lower, averaging at 2% for the third quarter. The second quarter this year, it was 2.8%. And much of this downtrend was driven by lower core inflation, which contributed around half of the decline during the third quarter. This also partly reflected effects from the higher base in the third quarter of 2022. Core inflation moderated to 2.5% during the quarter. During the second quarter, it was 3.4%, mainly due to lower inflation for core services such as food away from home, expenditure at restaurants and cafes, and repair and maintenance of personal transport. The moderation in core inflation is expected to continue until end of the year. Let me take a minute to speak on the risks to inflation. For 2024, headline inflation is expected to average between 2.1% to 3.6%, and this is based on the outlook by the Ministry of Finance. The wide range partly accounts for some upside impact from the proposed subsidy rationalization measures, where more precise details of these policies are currently being finalized. We will continuously evaluate their implications to the inflation outlook going forward based on the final implementation of these policies. In addition to the domestic policy factors, risks to the inflation outlook could also stem from global developments. Near-term upside risks include higher global commodity prices from geopolitical conflicts and potential disruptions from the El Nino weather phenomena, as well as higher import prices amid exchange rate pressures. These risks could be offset by more subdued global commodity prices driven by weaker than expected global growth, as well as more favorable weather conditions leading to lower pressure on food prices. Let's move to the next slide. Turning to monetary policy, the MPC maintained the OPR at 3% at the November 2023 meeting. At the current OPR level, the MPC deemed that the monetary policy stance remains supportive of the economy and is consistent with the current assessment of the inflation and growth prospects for Malaysia. As I mentioned earlier, growth next year will be mainly driven by resilient domestic expenditure. Inflation is also expected to remain modest. Going forward, the MPC will remain vigilant to ongoing developments to inform the assessment on the outlook of domestic inflation and growth. The MPC will ensure that the monetary policy stance remains conducive to sustainable economic growth amid price stability. Let's move on to the next slide on the ringgit now. The ringgit depreciated against the US dollar in the third quarter. This trend was also observed among other regional currencies due primarily to external factors, including the US monetary policy path. Malaysia's economy today is resilient, notably in terms of our economic fundamentals, robustness of our financial sector, and depth of our financial markets. The persistently strong US dollar is therefore not expected to derail Malaysia's growth prospects. Going forward, global financial market uncertainties are expected to ease, barring any new adverse developments such as heightened geopolitical tensions, as financial markets expect the US policy rate to be reduced next year. This should ease US dollar strength and thus reduce depreciation pressure on the ringgit. However, of late, we have experienced outflows from portfolio investment. In the third quarter, portfolio investment recorded a net outflow of 14.1 billion ringgit compared to an inflow of 8.1 billion ringgit in the second quarter of the year, due mainly to higher residence investments in equity and debt securities abroad. This also reflected the liquidation of domestic debt securities by non-resident investors, which has partially offset non-residents' acquisition of equity securities in Malaysia. To ensure balanced two-way flows, we encourage domestic investors to seek investment opportunities domestically, repatriate export and foreign income and investment proceeds, and sequence foreign investments. Ongoing and future investment projects and structural policy measures will enhance Malaysia's future potential growth and competitiveness, which will then attract foreign investments. These will provide a more sustainable support to the ringgit in the longer term. That being said, I want to emphasize that the bank remains committed to ensure the ringgit adjusts in an orderly manner, and in the longer term, it should reflect our economic fundamentals. Moving on to the bond market. In the bond market, bond yields on the 10-year MGS rose in line with regional peers amid the increase in US bond yields. Investors were largely expecting the US policy rate to remain higher for longer. On domestic equity markets, the announcement of structural reforms, including various national master plans, boosted prospects of corporate earnings of companies in the KLCI. Such structural reforms reflect Malaysia's ongoing policy imperatives. Greater investor confidence in Malaysia's growth prospects will eventually support a real appreciation in the exchange rate as external uncertainties start to recede. Turning to credit conditions, credit to the private non-financial sector expanded by 4.2% as at end of the third quarter, driven mainly by higher growth in business loans at 1.6%. Second quarter, it was only 0.5%, while the growth in outstanding corporate bonds was sustained at 5%. Quarter 2 was 4.9%. For households, outstanding loans grew by 5.4%, Quarter 2 at 5.1%, with sustained growth recorded across key purposes. In terms of credit flows, loan disbursements have remained forthcoming across both the business and household segments. Financing by banks and DFIs continued to support SMEs' business needs in the third quarter, with outstanding financing growing at 6.7%. Approval rates have been higher than the pre-pandemic levels, indicating banks are meeting the strong financial demand for investment-related and working capital purposes. Strong financing activity on both fronts reflect the improved business activity and elevated cash flows needs amid a challenging operating environment. In third quarter 2023, we saw financing disbursements sustained at high levels, particularly for working capital purposes. Disbursement growth for working capital purposes was primarily driven by the services sectors, notably in the wholesale and retail trade, real estate, and information and communication sectors. Turning now to the banking system's resilience. As indicated earlier, the banking system continued to play an important role in supporting growth during the quarter. Owing to their strong financial position, including higher levels of capital and liquidity buffers, banks remain well positioned to support the financing needs of the domestic economy. The quality of business and household loans remains sound, with the share of loans with higher credit risk and borrowers receiving repayment assistance moderating. Impairment ratios remain low and stable as well. These improvements have been supported by prudent loan affordability assessments by banks, which help to ensure that borrowers have buffers against rising costs. Even with these stable levels of impairments, banks remain prudent in their provisioning for potential loan losses, given an environment of rising costs and uneven recovery. For borrowers who continue to face financial difficulties, I wish to emphasize that bespoke loan repayment assistance from banks and AKPK remains available. Let me iterate that Malaysia's economic fundamentals remain strong and supportive of growth moving forward. GDP has exceeded its pre-pandemic levels, with continued improvement in labour market conditions. Malaysia's diversified exports destination and products will cushion the impact from moderating global demand. Our external position remains strong despite the external headwinds. with sustained net creditor position and continued surplus in the current account balance. In addition, our deep financial markets and strong financial sector will continue to ensure efficient financial intermediation and contribute towards economic growth. I've come to the end of the briefing. In summary, the Malaysian economy expanded by 3.3% in the third quarter of 2023, driven mainly by private sector expenditure. The 2.6% growth in seasonally adjusted quarter-on-quarter number also indicates a positive momentum in economic activity. For 2024, growth is projected to improve to between 4% to 5%, and this is anchored by domestic demand. There are downside risks as well as upside risks to growth, stemming from both external and also domestic factors. Headline inflation is expected to average between 2.1% and 3.6% for 2024. With that, I've come to the end of the presentation. Dato' Sri Dr. Muhammad Uzair, myself, and our team will be very happy to take questions from the media. Thank you.
Thank you, Governor. At this juncture, I'd like to call for questions from the media.
Hi, my name is Seiichi Oshima from GG Press, a Japanese news agency. How do you see the influence or effect of the lower ringgit on CPI and export as well in future into 2024?
Thank you for the question. The exchange rate pass-through to inflation, that is the amount that the ringgit depreciation affects prices, remains manageable in Malaysia. If you look at the PPI inflation in the past years has been minus 2.1%. Given current environment of low production costs, price pressure from import costs due to strengthening of the US dollar is reasonable. And historically, the exchange rate pass-through to inflation has been low in Malaysia. And why is it so? It's because the proportion of import in our private consumption is about 26%. And on average, for every 5% depreciation in ringgit US dollar exchange rate, it would contribute to 0.2 percentage points increase in inflation. Having said that, we will continue to keep a close watch on this, especially on the exchange rate pass-through for segments that have high impact, high import content, for example, like food and also just.
Hello, Governor. I'd like to ask about the U.S. Treasury monitoring list. Now, I take note of your response to Bloomberg recently and also all the other past statements. But I'm just wondering whether there is a need, or maybe I'm not sure how to put it, effort to get out of the list in the first place, especially since Switzerland kind of got out of the list, talking to and discussing and giving information to the Americans. So I'm just wondering whether there's effort to be out of the list in the first place. Thanks.
Thank you, Jason. Any other questions on the economy?
Hi, Dato'. Ram here from Bloomberg. How concerned are you about the plan to move to targeted subsidies next year? I think you mentioned one of the downside risks of that as well, and also the ongoing Israel-Hamas war. Do you foresee any impact from that for Malaysia's economy in the near term?
Thank you. Governor, I think we'll take these three questions.
Yeah.
The first question from Jason is on our inclusion, comments on our inclusion of Malaysia in the US Treasury monitoring list. The second question is our concerns, whether we have any concerns on targeted subsidies.
Okay.
And the last question is the impact of the conflict in the Middle East on Malaysia.
Thank you, Jason, for that question. I think I'd like to explain that countries are mechanically placed on the US Treasury report monitoring list. They look at the certain parameters and it's mechanically categorized. Malaysia meets 2 out of the 3 conditions set by the US Treasury. Number 1 is in terms of having trade balance with the US of more than 15 billion. Ours is about 31 billion. Second is in terms of the current account surplus of more than 3% of GDP. Ours is 3.3%. So we met these 2 conditions. So based on that, we will mechanically place under this category. But we must understand that Malaysia continues to maintain a diversified external sector, and a large part of our trade surplus with the US reflects the major presence of the US investors in Malaysia, especially in electronic sector. Our intervention is also two-way, both the directions. And although they acknowledge this, but it is still mechanically categorized. I think if you look at the US report, they do acknowledge in terms of Malaysia's position, but yet based on the mechanical approach taken, so it's still categorized under US Treasury. Okay, in terms of the subsidy, Ram, I think if you look at the latest official forecast by MOF, is between 2.1% to 3.6%. And this has undertaken some assumption in terms of the gradual move towards a more targeted subsidy mechanism, among others. There are many factors that would affect how policy adjustments impact inflation, including in terms of specific timing, magnitude, and also the mitigating factors that is introduced when we implement subsidy rationalization. There are measures that can help keep prices under control. For example, alongside the plan to progressively increase diesel prices, the government indicated that they will provide targeted fuel subsidies to selected businesses. And this would partly reduce in terms of the impact on business production costs, later on in terms of impact on inflation. And we have seen during the initial stage of the GST implementation in 2015, for example, the government implemented various measures to prevent traders from exploiting the tax transition to unjustly increase the prices for goods for excessive profits. But this include in terms of enforcing the Price Control and Anti-Profiteering Act 2011, strengthening enforcement through the establishment of the National Price Council, and publishing the Shopper's Guide and designating supermarkets as benchmark prices. So this has been done in the past. So these are the kind of measures that can be continued in terms of making sure that it does not affect in terms of inflation so much. But having said that, in terms of the impact on inflation, you ask us now whether our concerns. So this is where we have to monitor closely. For example, in terms of the contributions to price increases, what's the source of the increase? Is it due to the supply shock, or is it due to demand pull kind of elements? If it's due to supply shocks, there are many ways of, for example, in terms of making sure that we control price increase, and also enhancing in terms of enforcement to make sure that it's controlled, it's not justly increased. But if we do see in terms of demand pull kind of like pressure coming from second round effect from the subsidy rationalization, so that's where we will then basically look in terms of the data and be vigilant in terms of incoming developments that we observe, and then we will act appropriately. And thirdly, in terms of West Asia, developments in West Asia, our direct trade exposure to West Asia is very small. It's about 4.9%. And even if you look at our bank's exposure, it's also very small, at 1.7% of their total external debt and 3.2% of their total external assets. If the conflict escalates, global growth can be affected via three channels. One is through the volatile financial markets. Second is through higher commodity prices. And third, supply chain disruption. That's what we have seen after the Ukraine and Russia conflict. At this juncture, the conflict influence on global growth is rather contained, with very negligible impact to our growth, and we shall watch this development very closely.
Thank you. Thank you, Governor. May I invite another round of questions on the economy? Hanum.
Assalamualaikum, Governor. The overall tahun ni economy on track to achieve 4 to 5%. And then for next year with the increase in services tax, is it impact on the inflation?
Thank you, Mahanum. May I invite another question on the economy?
Hi, I'm Youngman from Sincho Daily. With the subsidies rationalizations, would it impact the domestic demand? And if the domestic demand has been impacted, will the GDP momentum remains?
Thank you. I'll take one more question.
Hi, I'm Shauki from the Malaysian Reserve. Okay, looking forward, given the anticipation of U.S. monetary policy tightening nearing its end, how do the speakers foresee this influencing the Malaysian economy, particularly in terms of exchange rates and global financial conditions?
Thank you, Governor. I think we'll group the questions together. The first is whether or not we are on track to achieve the growth target. The other questions are related to the service tax and the impact on inflation, domestic demand, as well as growth.
Right, thank you, Manu, for the question. I think in terms of by now, there are many indicators showing how resilient the economy is. And despite all the external shocks, growth in the first 3 quarters of this year was 3.9%. And based on the latest indicators, growth for 2023 is still expected to be around 4%. And you have to see that Malaysia has a well-diversified economy and also export structure. And also we have our exporters' agility as well to actually adapt to changing environment, and also in terms of demand from the external sector. And so this is where we believe, if you look in terms of the indicators with regard to growth for 2023, we see there are positive growth as well in terms of the demand for passenger cars, and also in terms of the private consumption. So this is where we feel that the 4% growth as we targeted is actually achievable this year. That's for the 2023. And the service tax next year, it may have some impact in terms of the consumption, but we have taken into consideration all the announcement that's made in the budget into our growth projection for next year, between 4% to 5%. Next question is in terms of subsidy rationalization, impact on GDP. As I mentioned earlier on, it depends in terms of the finalized detail that will be issued, that is being finalized now, in terms of the magnitude, in terms of the sequencing, and also in terms of the amount of subsidy rationalization that's being undertaken. And this, as I said just now, will have some impact, could have some impact in terms of inflation. But this will also come with targeted assistance to the targeted segments of the economy. And this will also support consumption from that perspective. So we believe that that's why we look at the inflation forecast, it's quite a big range this time around, from 1 to 2.6%. Let's take into consideration the possibility impending implementation of subsidy rationalization. And the final question is on the US tightening and impact on the Malaysian economy. As we said that the movement in the ringgit exchange rate is heavily influenced by external developments, and this ranges from many points in terms of the strong US dollar, and also the China's weaker than expected economic performance, and also to the geopolitical tensions that we have seen in the Middle East. As I said in the presentation, in terms of the US tightening, we do see that they may be at the tail end of the tightening cycle. And once this happened, then you'll see in terms of support for the ringgit will be there for it to further strengthen. And in terms of impact of the US tightening in regard to our monetary policy, our monetary policy is dependent on the domestic our focus is more in terms of the inflation outlook and growth outlook domestically. We only take into consideration what's happening globally, including in terms of the tightening cycle in the Japan's economy, how this will have an impact on our inflation and our growth prospect. So that's how we take into consideration regard to the impact on inflation and growth, and then we calibrate appropriate monetary policy. Thank you.
Thank you, Governor. Let's move to the second section, a segment of the questions on the financial sector. May I invite questions from the media on the financial sector? Jason?
Can you just quickly talk about the Basel IV on banks, whether they've prepared for it, or how well prepared they are for it? Thanks.
Thank you, Jason. Any other questions on the financial sector? Well, if there are no further questions, Governor, the question from Jason is on banks' preparedness for Basel IV.
I'll get the Jess to take up the question.
Not quite done with Basel III. Well, so our bank's capital ratios right now, as you know, are very, very strong. They are currently capital ratios 18%. We are progressively putting in place the enhancements that the Basel Committee has made to its standards. But by and large, most of the, as far as, for example, credit risk, most significant risks to our banks, those standards are well entrenched. We will be adopting some of the additional enhancements. That consultation with the industry will take place sometime next year. We have already adopted Basel III. We are on Basel III already. And so these other components of the new standards, we're progressively phasing it in. We expect that will be, the main pieces are already within our frameworks. The one that will come most likely will be the credit risk enhancements, which we plan to do in the coming year. We'll consult in the coming year. So that will be the major piece. The other pieces from our exposure of the banking system, they are not very significant in terms of improvements.
Okay.
Thank you, DG. May I invite another round of questions on the financial sector? Lady here in front.
Hi, Ayatun from The Sun. I want to ask, how do you see the digital banks competing? How are they going? How do you see they are sustaining against the incumbents, bigger banks? What's the plan? Yeah, can you share on that?
Thank you, Hayatun. Any other questions on the financial sector?
Hi, Youngman again. I just want to get some updates on the financial scams related issues.
All right. I think we have two questions. The first is on our plans and progress of the digital banks. Second question is related to scams.
Thank you, Washan. Thank you for the questions. I'll get Digi Sham to answer on the scams, but I'll take up the question on the digital banks. I think, as you know, recently on 1st September, the GX Banks was the first digital bank to receive approval to commence operations, and we have 4 more to come. But in terms of the impact with regard to the competition for the existing incumbent banks, we don't see it as negative points. In fact, it could be a very positive point to enhance further competition, and this will be good for consumers. But you also need to understand that for the digital banks, their focus will be for the unserved and the underserved segments of the economy. So there are areas where it's not being served currently by our existing incumbent financial institutions. So these digital banks will come in to actually cater to this market. So it will complement all the services and products provided by existing banks. And there's also no restrictions for the existing incumbent banks to move towards digital as well. In fact, most of our banks have been moving towards digitalization, and this will further enhance and improve in terms of the efficiency, also in terms of the competitiveness. That's on the digital bank. Let me move on to scam. Let me invite Sham.
Thank you, Governor. In terms of the scams, our approach have been three-pronged. The first is we're looking at prevention. Second, it's in terms of helping those who fall victims to scam and enforce the enforcement. And third is, of course, in terms of financial education and awareness. Prevention, you recall that in September, last year, we introduced the 5 countermeasures, and the banks have all made progress on this. All these have been have been implemented. We have also strengthened expectations for banks to further improve fraud detection rules. Banks have been also asked to undertake more timely and robust investigation of fraud cases. We have also asked them to be properly explained and provide customers who fall victim to scams in terms of information on the progress of the investigation carried out by the banks, the timelines, and of course the rights of consumers who actually became a victim of this. And SRC, the National Scam Response Center, have been operating well. It has received more than 19,000 reports of fraud cases involving more than 188 million ringgit. And the police has opened more than 6,000 investigation papers. Progress have also been made. There have been successful cases where funds have been returned back to the victims. So progress have been made on that. We are working closely with the police, with the AGC and other government agencies. And thirdly is that the best defense is still again on all of us, the customers, the consumers, for us to make sure that we continue to practice practice good cyber hygiene, be careful, be in terms of how we conduct online banking, don't share our passwords, don't give details of our information, banking details to unknown people, and all that. So we are embarking a lot on awareness campaign. Thank you.
Thank you, DG. Thank you, Governor. Speaking of the scam awareness that DG just mentioned, there is an anti-scam festival happening in Wan Utama now until Sunday. And this is just one of the many initiatives that Bank Negara and the banking sector has organized. So the media can visit if interested. Maybe let's move on to the last segment of the questions on just general other topics. May I invite questions from the media? Lady.
Hi, I have questions regarding Monetary Authority Singapore published a consultation paper on proposed shared responsibility framework. Will BNM take a similar action?
Thank you. Any other questions from the media?
Hi, Governor. We have seen that ringgit continue to decline against US dollar, closing on 4.8 mark and something. Do you see ringgit will hit 5?
Thank you. I think we'll take these two questions. Governor, the first question is on whether we are adopting a similar liability sharing framework and whether we see ringgit hitting 5.
Thank you, Varshan. Thank you for the two questions. Let me just answer on the shared liability. Then perhaps I think some can come into add as well on this, and also answer the questions on the ringgit as well. I mean, in terms of the discussions surrounding the equitable loss compensation with the industry have been ongoing. This is a very complex issue actually. Why I say it's complex? Because prevention of fraud is actually, as I mentioned just now, is a collective responsibility with different parties involved, which can include banks themselves, consumers, and also the other service providers that are actually being used through the banking app and everything. And any framework that we introduce must be fair to all parties involved and should not lead to any unintended consequences such as. So that's one principle that we must actually ensure that we adopt when we discuss or consider this shared liability framework. Notwithstanding this, the bank together with the industry, we have taken various measures to strengthen fraud mitigation. I think DG Sham has actually highlighted this in terms of what we have done. And we have also strengthened expectations for banks to further improve fraud detection rules. and undertake more timely and robust investigations of fraud cases, especially when involving unauthorized transactions where customers are being held liable. So this is what we have asked banks to do. And we are looking into this, and we are in discussions with banks, and ensure that we come up with a fair and equitable kind of framework in terms of shared liability. So that's the first question. On the ringgit, I think ringgit performance since last year was mainly, as I said, due to external developments, not so much in terms of what's happening in Malaysia. And we have been managing this through our presence in foreign forex market. And our aim is to really manage excessive volatility and ensure that orderly market. So that's what we do. And we also have increased actually engagement with the businesses to ensure the exchange rate risks are properly managed. And also we advocate a prudent management of national investments as well to the businesses. And we also have been promoting the use of local currency for trade settlements, and this will also help in terms of reducing pressure on ringgit. For example, the arrangement we had with China, about 25% of the trade settlements are now done in local currency. And we also have with Indonesia and also with Thailand. With Indonesia, I was told that about 17% of the transactions are being settled in local currency, and with Thailand, about 19%. And in short, I think currency should reflect, the currency movement normally reflects a host of factors, sometimes beyond the underlying strength of the economy. It could also be due to sentiments and also uncertainties that could affect in terms of the movement of the ringgit. However, in the longer run, we believe that it will reflect the underlying economic fundamentals that we have been highlighting throughout the presentation today as well. And we believe that the current level does not reflect our fundamental. For example, just now we have a strong growth, very resilience. We got favorable labor market conditions. We've got low inflation. We've got strong external sector, and also with the current account surplus. And we have strong banking sector that can intermediate funds in the economy, and also a very deep financial markets. And these factors, plus the structural reforms undertaken by the government, this would really, moving forward, attract more investments, and this will provide a more enduring support for the ringgit. So that's why we see all these external elements may recede soon. Once this has receded, then it will truly reflect fundamentals of the economy. Thank you.
Thank you, Governor. So our media friends, thank you very much for all your questions. We have come to an end to our press conference today. Governor, may I invite you to give your closing remarks?
Let me thank everyone for all your questions today. A few things before I conclude this session today. We know that the flood season is upon us now, and for borrowers affected by floods, help from the financial institutions is always available. For the MSMEs affected by floods, they can actually apply for the Bank Negara Malaysia's Disaster Relief Facility to help resume business operations. Secondly, I've been informed that there are people using Bank Negara Malaysia and the names of Bank Negara Malaysia officials to promote investment schemes and the likes. Please remember, Bank Negara does not endorse any investment schemes, and scammers often change their modus operandi as well. With that, let me thank everyone for your presence today and see you at our next event. Thank you very much.